We're joined by Mr. M. Anandan, who is the Chairman and Managing Director at Aptus Value Housing Finance. A very good afternoon to you, Mr. Anandan. There is Cheryl on the other side. Thank you so much for joining us on ET now. And let's talk about the quarter gone by. You've seen a strong loan growth. If you could tell us how comfortable are you with the asset quality now, given that the loan growth that you've clocked in the quarter gone by?
No, we had, as you mentioned, very good growth. In fact, quarter on quarter, and for the half year, we had almost our disbursements has gone up by about over 60%, and our loan book also has gone over 30%. And this growth is coming. In fact, we are, for all practical purposes, we're back to the normal growth and growth prior to the COVID. And so growth alone is not our primary focus. Our primary focus also is really mainly the quality of our loan book, and there is a significant improvement in our quality of loan book in the last 4 quarters. And the quarter ending September, we had the lowest NPA of gross NPA of 1.47, net NPA of 1.1%, and our credit cost has really come down to about 0.6%. And in terms of even the soft bucket outstanding, there are 30 plus or 60, 90, those aspects also really come down, basically because of collections have really stabilized little more than 100. Even for the quarter in September, our collections were about 101%. And so, in other words, the collections have really picked up very well, despite the inflation, despite the other issues in the overall economy. But we see our EMIs coming on time. So that has really helped us in terms of improving the quality of the portfolio. And of course, we also follow a very prudent policy in terms of provision for NPA. We carry closer to about 1% of the entire loan book as a provision. And in fact, in the last 6 quarters, we have really built it up to a level of about almost 59-60 crores. We have really taken up the provision from about 0.3% to about 1% now.
Sure.
And we also got a policy in terms of writing off any overdues beyond 24 months, 100%. So I think overall, and our financial metrics continues to be very good.
No, point taken. I get your point, but I just wanted to understand, you have a lot of exposure when it comes to the rural economy, right? 71% of your book exposures towards rural. What gives you this confidence that you'll be able to maintain the asset quality, given that we just spoke with the management of Pidilite as well, and he was talking about how rural economy is still a tad bit weak. What is the asset quality trend you are seeing on the ground?
Our core philosophy is our customer profile. Our core strength is in handling, loan demands of this category of customers who are largely in the low and middle income, largely self-employed, largely living in rural areas, as you mentioned. And in fact, these are really coming for the first, homes. And closer to 80% of our customers, they live in their homes after constructing it. So given this kind of, and this is where, the real need for homes and home loans really rests in the lower and middle income population only. And to that extent, the market pie is large. And same time, as long as, the caveat is that you need to have an excellent credit underwriting systems and processes, and also outstanding collection mechanism. Of course, apart from the valuation, legal aspects and things like that. But that is what we have mastered for this category of customers. That's why our performance in terms of NPA is one of the best in the industry for almost 10 years now, year after year.
Right, so let's switch now to profitability. And if you look at your NII growth in the quarter gone by, was really strong. But your yields, if you look at them, they are
flat on a quarter-on-quarter basis. A large chunk of your book is fixed in this scenario. Would it be actually right to say that your NII growth has come entirely from growth of your book? And will that continue if it's the case going forward as well?
Yeah, actually, it's a very important point that you've touched. Basically, we have not gone for any revision in our EMIs, despite significant increase in the interest rates. We are very strong on our liability side. Our gearing is low, and whatever loans that we have also got long-term loans with a fixed interest component, and even a small portion of that is the variable loans, but there also that will get reset only on a yearly MCLR basis. So given that the actual incremental cost increase on the finance cost is really relatively somewhat less, at least we expect the situation to continue at least for this financial year FY23, and this will also be further helped because in addition to our existing source of funding, we have undrawn sanction about 500 crores from the NHB, which normally made available to us at a much lower cost and for a long-term tenure for 10 years and things like that. So that will also help us to really take care of the next balance 5 months. So given that, basically, if we look at our about 6,000 crores of balance sheet, 3,000 crores is our net worth. Of the balance, 3,000 crores are borrowing. Closer to about 2,000 crores are really fixed interest rates for a 5-year and about loans. And the balance, balance about 1,000 crores is what we have the variable rate that also is really linked to the MCLR or ODR. So to that extent, the impact on us is less, and we are quite, and given this situation, we have decided not to go for an increase at this point in time.
Sure, Mr. Anandan, that point is taken. Thank you so much for waiting patiently and talking to us about your business as well as the outlook going forward. Really appreciate your time today on ET Now.